The OPR cuts in 2025, it's squeezing every bank net interest margin, but mBank, we're feeling it more than most. 72.4%. That's how much we depend on interest. One rate cuts and our earnings tremble. We've been relying on loans for too long. Well, fintech is our lunch, we're still acting like it's 2010.
Hey, do you know what this meeting is about actually? He told me bring financial year 2025 data, but which part?
The whole picture, I think. But Kahan, your IT data will probably come first. He'll want to see where the customers are going before he dives into the financials.
My dashboard show customer migration getting worse. I will present first if he asks.
Maybe I'll cover the Campus framework and how our recommendation can improve the regulatory rating.
Yeah, and I will handle the packaging after you all present the problem and solution.
Good, advance you. So, shall we start? You four are my sharpest mind, so I'll be direct here. I think all of you have known about the issues that we're currently facing. The issues regarding our revenue drops and clients moving out. Kahan, you first. What does your IT data say about our customer situations? No sugarcoating.
Sir, now let me show you what my IT system and the latest industry number are showing us. So for the latest retail banking trend, traditional bank transaction grow only 30.69%, significant customer shift to fintech and digital bank in the payment and small lending. According to the PayNet, non-bank digital payment has grown by 71.7% last year, while traditional bank like us only grow 30.69%. And bank owns 2025 annual report even admit that digital competition is getting much more intense, especially in the mass market where fintech and digital banks are capturing new customers. The BNF Finance Stability Review also warned about this exact risk. Study by Tarawetne 2024 and Meyapan 2025 both confirm this level of fintech competition is really hurting traditional bank fees-based income, which is why our non-interest income only managed to grow 1.3% last year.
So customer migration is already showing up in our number.
Yes, sir. That's exactly why we need to move faster on diversification.
Okay then. Jerry, what's our company latest Campus health check?
Sir, when we're gonna use the Campus framework to evaluate us, here's our current positions. The capital asset quality management ability seems all strong, but earning sensitivity are vulnerable. Why? Because 72.4% of our income comes from interest. A plus minus 100 basis points rate shift swings our profit by 930 million. The OPR cuts to 2.75%. It's already showing in our sensitivity and earnings scores. That's why diversification is urgent.
So you mean that the framework confirms our interest dependency is a real regulatory risk, right?
Exactly, sir.
So, Kahan and January just showed us the customer problem and the regulatory risk. Here are my three strategic recommendation to stop the bleed and diversify the revenue beyond interest income. So my first recommendation would be to launch an MBS program. MBS, mortgage-backed securities. We originate mortgage, package them into securities, and then we sell them to institutional investors. We can earn underwriting fees and servicing fees from this way. As Saunders and Cornett explained in the textbook, in the famous basis textbook, securitization converts interest income into fee income while reducing balance sheet risk.
So you mean that we will be earning fees instead of 14 years for interest payment, right?
Exactly, sir. Faster revenue, lower risk. Recommendation 2 would be to capitalize on the corporate ESG advisory. So the World Bank Securities Commission Malaysia data shows that 54% of commercial portfolios depend on ecosystem services and 87% face high environmental impact. So we step in with the green bond underwriting and ESG advisory fees. I believe I've read this before. Rose and margins come from investment banking drives stable non-interest income.
Fintechs can do that.
No, sir, that's not our norm. Recommendation 3. Strengthen the wealth management, bank insurance, strategic fintech partnership. Those 3. So basically, wealth management, bank insurance, and fintech partnership. Because Taraweh found that fintech collaboration have a positive and significant effect on profitability. What if we cross-sell wealth products, partner with fintechs selectively, and expand our open banking API?
Financial impact.
Successful execution lifts the NOII from 27.6% to 35% to maybe perhaps 1% within 2 or 3 years. I believe you mentioned this about Mayapan earlier. He confirmed that Malaysian banks with higher NOII achieve better risk-adjusted returns. On the other hand, Seho added that the moderate financing diversification significantly improves bank stability. Lower earnings volatility, stronger Kamal's rating, better ROE.
Short, clear initiative.
So, Kehan showed us the bleeding, Nigel gave us the cure. Here's how we make customer and investor want it. So, I already provide you 3 package, which is package 1 is M-Secure MBS, which is Nigel MBS program is not for retail customers. It's for institutional investors. We brand it as M-Secure MBS, Malaysian Mortgage, institutional grade. Pitch to EPF and KWSP insurance companies and foreign fund. The underwrite fee comes from them. The second one is M-Green Advisor, which is ESG advisor target our top 200 corporate client. We offer green bond underwriting, sustainability reporting, and transition financing advice. Fee structure around 0.5 until 1.5% of insurance value for bonds, project-based fee for advisor. So the other package is M-Wealth Plus or NMAPI Connect, which is wealth management and bank insurance cross-sold to our existing 8 million customers, plus strategic fintech partnership through our open banking API and we don't fight fintech, we partner with the right ones.
So how do you and Nigel collaborate on this?
He gave me the unit economic and fee structure. I give him customer and investor willingness to pay the data. We meet twice as a week.
Our shared model is already running, be it MBS pricing, ESG fee scenarios, blood product margins. It's all that.
Perhaps show me the woods, Nigel. Prescribe the medicine, Ariel. You figure out how to sell it, and that's collaboration.
We just needed you to stay close.
Alright then, here's my decision. Technically readiness by this Friday. Can our system handle MBS service tracking, ESG advisory client portal, and also AppCam partnership for fintech collaboration?
Okay, MPS tracking, yes, 50 days, ESG portal, 35 days, and API expansion, we already have the foundation, 30 days to scale, so my team is ready.
Approved. John, I want the full strategy roadmap and update Camel's impact analysis by next week.
I think you will have it by Friday, sir.
Good. Nigel, finalize model for all three recommendations by Monday, include MBS underwriting fee projection, ESG advisory revenue scenario, and also wealth management cross-sales targets. Show me the Camel's improvement.
You have it by Friday evening, sir. Moving NOI from 27.6% to 35 to 40% reduces our 930 million sensitivity swing by approximately 250 million.
Alright, document that to the board. Alright, go to market roadmap in 2 weeks. Target institutional investor for MBS, top 200 corporates for ESG, and retail wealth customer to M Wealth. Include fintech partnership selections criteria.
I think 10 days. And I want to soft launch and green advisor with 5 pilot corporate clients.
Smart, do it. The OKR card shows our weakness, but Nigel, 3 recommendations, MBS, ESG, wealth, and also fintech partnership shows our path forward. Revenue diversification beyond interest income isn't a bad plan. It's our only plan. Meeting is missed.